Welcome to the deep dive. Today, we're plunging into the world of initial public offerings, IPOs.
Right.
You've shared some really interesting material exploring how IPOs function, the reasons companies do them, and, well, the pretty big shifts we've seen.
Yeah, the landscape has certainly changed.
So our goal is to unpack these changes, sort of pinpoint what's really different between older IPOs and the ones today, and ultimately understand what this means if you're trying to get a handle on this part of the financial world.
Hmm.
We're drawing on an article from September 2024, IPOs, Old and New, Key Strategies for Investment in Current Scenario of IPOs.
Okay.
So the big question is, what are the key differences, past versus present, and what does this evolution tell us about the market?
Okay, let's get into it.
Precisely. I mean, the IPO market, at its core, it's still about a private company offering shares to the public for the first time.
Sure, the basic idea. But it's actually a very dynamic area. It mirrors, broader economic and tech developments. The article outlines some key reasons companies take this, well, pretty significant step.
Right.
Traditionally, the main driver has just been to secure substantial capital.
Makes sense. Money.
Yeah, money to fuel expansion,
Mm.
maybe support crucial R&D, pay down debt, or even enter new markets.
Exactly. Getting the resources to grow, take things up a notch. But the article also points out some other benefits, things that might not be immediately obvious to you listening.
Right. And what's fascinating here is how going public really elevates a company's standing, in several ways.
Okay.
So beyond just the cash, it significantly boosts visibility and credibility.
Ah, right, reputation.
Exactly. And that better reputation can attract more investment, maybe strategic partnerships down the line. Plus, an IPO gives a much-needed exit route for early investors, the founders.
The ones who took the early risk.
Precisely.
Yeah.
And even on a more sort of day-to-day level, being publicly traded, it can improve a company's pull for top talent.
Oh, interesting.
Yeah, and help them negotiate better terms with suppliers, maybe even customers. It's kind of a multi-layered set of advantages.
So, a really significant move, potentially a lot of upside, but it's not all smooth sailing, is it? There are definitely challenges.
Oh, absolutely. The article touches on some of those inherent hurdles. Suddenly you've got this constant pressure, right? Satisfy shareholders,
Yeah.
meet quarterly earnings targets.
Which can lead to short-term thinking sometimes.
It can, yeah. It can encourage that focus. And of course, the regulatory side gets much more intense, more scrutiny, more compliance stuff.
Mm-hmm.
But despite those very real hurdles, the potential upsides, especially for companies really aiming for growth, often make that IPO journey seem pretty appealing.
Okay, so we get the why. Now, let's get a sense of the scale here. The article had some, well, pretty striking numbers.
That's right. The sheer volume over the last, couple of decades,
Mm.
it really shows the activity. Between 2000 and 2024, we're looking at 6,212 IPOs.
Wow, 6,212. That's a lot of companies going public.
It is.
But it hasn't been steady, has it? The article mentions some real peaks and valleys.
Exactly. It highlights these big swings.
Mm.
For instance, remember the financial crisis in 2009?
Yeah.
The number of IPOs just plummeted, dropped to only 62 that year.
Only 62? Wow.
Really shows how the broader economy hits this market. But then jump forward to 2021,
Okay.
a record-breaking surge, 1,035 IPOs.
Over 1,000.
Yeah, which was way more than double the 480 from just the year before 2020. So it really shows how dynamic, how unpredictable the IPO market can be.
Those numbers definitely paint a picture of the market's moods. Okay, so lots of activity, but the kinds of companies going public, that seems to have changed quite a bit. Let's dig into that old versus new idea from the article.
Right, and this is where it gets really interesting. It speaks to, the heart of our discussion. Historically, what the article calls old IPOs, they're mostly dominated by, established companies.
Like the big names.
Yeah, I think major players in manufacturing, maybe traditional retail, established finance firms, these were businesses with long operating histories, track records of consistent profit, market stability.
Solid, dependable.
Exactly. Investors back then were generally looking for stable long-term returns. These were seen as, lower risk investments.
That makes sense. Established businesses making money. So how does a new IPO compare?
Well, today's picture is quite different. New IPOs are often younger, tech-focused firms. And crucially, many of them aren't actually profitable when they go public.
Right, we hear about that a lot.
Yeah, we're seeing loads of startups, those unicorns, valued over $1 billion privately hitting the public markets.
So tech, biotech.
Exactly. Tech, biotech, fintech, those are the dominant sectors now. And the investors, they're generally more willing to take on higher risk for potentially much bigger rewards down the road.
A different risk appetite.
Definitely. And the article also mentions the rise of alternative methods, like direct listings.
Where they don't raise new money initially.
Right, existing shareholders sell directly. And SPACs, the special purpose acquisition companies.
The blank check companies.
Yeah, essentially shell companies merging with private ones to take them public. So different paths to getting listed now.
Okay, so a really fundamental shift from established profit makers to younger, high growth potential, often unprofitable companies. And it sounds like tech, the tech revolution, has been a huge driver here.
Oh, absolutely massive. Tech firms, especially out of places like Silicon Valley, have just fundamentally reshaped the whole IPO scene.
How so specifically?
Well, one huge impact is normalizing these really high valuations, even without current profits.
Mm.
Think about Uber, Airbnb, Spotify.
Yeah, huge valuations, but losing money when they IPO'd.
Exactly. Billions in valuation while operating at a loss. That shows a major shift in how investors value companies much more focused on future growth, market disruption, rather than immediate earnings.
Betting on the future.
Pretty much. And as the article notes, these tech firms have also really pushed the adoption of those alternatives, direct listings and SPACs. They often see them as more cost-effective, more flexible than the traditional IPO process.
Which involves the investment banks underwriting it.
Right, where the banks buy the shares and resell them. And just the sheer excitement, the investor hunger for the next big thing in tech, that's definitely fueled the pace and volume of IPOs, making the market more dynamic, maybe more volatile too.
It really does sound like a different ballgame, and I guess investor expectations had to change right along with it.
They really did. Historically, like the article says, investors prioritize companies with long histories, consistent profits. The big established firms in finance or manufacturing.
Stability was key.
Yeah, the focus was on strong fundamentals, steady long-term growth, consistent returns, less risk.
So how does that compare to what investors seem to want today?
The shift is quite dramatic. Now, there's a much bigger appetite for high-growth firms, disruptive tech, even if they're not making money right now.
Like the Uber and Airbnb examples again.
Exactly. The article points out their big losses didn't scare off investors who were betting on future growth, market dominance. We're also seeing, higher expectations for transparency, adaptability in the IPO process itself.
Interesting.
Yeah, today's investors seem, more willing to accept higher risk if they see that potential for huge rewards later on. It reflects that broader trend we mentioned, prioritizing innovation, rapid growth, sometimes over traditional stability.
But that sounds riskier too, potentially.
Oh, it definitely is. I mean, this shift, while it offers chances to get in early on potentially disruptive companies, it also brings in more speculation. You're betting on a future that might not happen,
Right.
which can lead to more volatility, maybe bubbles, compared to the more, let's say, grounded valuations of the older, profitable IPOs.
Okay, so if you're an investor looking at a new IPO today, especially one of these tech ones, what are the key things you really need to examine?
The article gives some crucial pointers here. First and foremost is the financial health and the business model.
Even if they're not profitable yet.
Especially then. You need to really scrutinize revenue growth, understand their path to profitability, how they plan to get there, and just assess their overall financial sustainability. That deep dive is essential.
What else? What signals are you looking for?
Well, like understanding how they plan to use the IPO money. Is it for R&D and future innovation? Or is it mostly just paying down existing debt? That tells you a lot about their priorities and potential growth trajectory.
Right, understanding their plan. What else?
Then understanding the industry landscape and their competitive position is vital. Where do they fit? What's their long-term potential in that specific market? Who are the competitors? What are their real advantages?
Okay, context matters.
Hugely. And then there's the critical point about IPO valuation. The article warns about getting swept up in the initial hype.
Paying too much.
Exactly.
Yeah.
Overpaying based on, super optimistic growth forecasts that might just not pan out. That early excitement can definitely inflate prices beyond what's sustainable.
So homework on the actual value, not just the buzz. Anything else for you, the listener, to check?
Yes, analyzing the planned use of the IPO proceeds. We touched on it, but how will they deploy that capital? Expansion, debt repayment, R&D. It indicates priorities, future direction.
Got it.
And finally, you just can't ignore the broader market environment. Market volatility, general investor sentiment, these things really impact IPO success. You have to balance the inherent risks of a new IPO against potential returns, considering the wider economic climate.
So a lot for you to investigate beyond just the company name and the initial excitement, especially in tech.
Definitely.
Okay, let's circle back then and just really try and nail down the key takeaways on how modern IPOs have evolved.
Yeah, the evolution's been pretty significant. If you contrast those traditional IPOs, big, established, profitable companies, often with that structured underwriting by banks, setting the price, managing risk,
Great, the old model?
with what we see today. The difference is stark. Modern IPOs are increasingly dominated by tech startups, high-growth firms. They often have rapid growth rates, maybe eye-watering valuations,
Even with losses?
even with losses, yeah, like Uber, Airbnb, Snowflake. The investor focus has clearly shifted more towards future potential, future development, rather than immediate profit.
And the methods have changed too.
Right, and we're seeing much more use of those alternatives, direct listings, SPACs offering flexibility, potentially lower costs compared to the traditional route.
So a real transformation driven by tech and shifting investor priorities. So for you listening, navigating IPOs today, it requires a very different perspective than maybe even a decade or two ago.
That's absolutely right. It's crucial to keep these transformations in mind, that fundamental shift from established profitable firms to often unprofitable, high-growth tech companies.
Yeah.
How investor expectations have evolved to prioritize future potential, disruption, and the rise of new ways to go public, like direct listings and SPACs, that adds complexity, but also opportunity.
So you really need to consider.
You really need to carefully weigh the company's fundamentals, the wider market context, and just grasp those significant differences between the IPOs of yesterday and today.
It's definitely a landscape demanding careful thought, a nuanced view. And maybe on that note, here's a final thought for you to chew on. Given how fast technology keeps changing and how investor appetites seem to keep evolving, what totally new ways of going public might we see pop up in the coming years? And how could that reshape how we think about company growth and investment?
Interesting question.
Thanks for joining us for this deep dive.